Sunday morning, once again, welcome back. Weekly market recap. There is a little bit of a shitty weather outside. It's foggy. There's a lot of humidity. It rained a little bit throughout the week, so it looks more like being in Great Britain than being in Italy at the current moment in time. And of course, as you can hear, my voice is getting in the mood of the weather. So if you have the impression my voice is particularly raspy, that is the reason. There is a very strong correlation in between my voice and the weather. But yeah, with that out of the way, let's jump into the economic calendar and the charts because it was a very intense week. Because of course we got the most important macro data points of all time, which is of course as usual. I'll let you guess, didn't you? All right, it's the CPI, of course, right? CPI is always the most important and impactful data release uh, up until the next one, the following month, of course. So, after a little bit of irony, let's have a look. Now, of course, you got CPI month over month. It came in at 0.3%. It's in line with what was the prediction, more or less. And, most importantly, we are still, if you look at the year over year, still hovering around in this range, mid in the middle of the 2% range, right? So, not worrying, contrary to what I see other people being worried about. For me, at the current moment in time, it's not. And we're gonna dig a little bit into it later on because spoiler alert, we are gonna talk mostly equities and of course bonds, and most importantly, as you might can tell from the thumbnail, yields. All right. Also, we got the Bank of Canada again coming in with another cut. Now they are at 3.25% for the overnight rate. And the European Central Bank cut as well. So we are now down to 3.15 as for the range, uh, coming from 3.40, right? So again, does it mathematically means that the next week the Fed is going to cut? Well, if you check the futures market, they are attributing a 90. Last time I checked, it was about 98% probabilities of a cut of a 25 basis points. So I might say, yeah, I mean, we have seen this tendency from the Fed to, give the market what the market was kind of predicting or forecasting. So they don't want to spook the market, so probably they're gonna cut, or that amount. And as usual, the Fed, it's just doing what the market is suggesting more often than not. I'm not talking in absolute terms. We also got the PPI in the US, which came in just a bit hotter than expected, which, paired up with the the CPI, and the yields immediately spiked to the upside. And everyone is talking about, oh, we got a reinflationary problem. This is the 70s once again. You'll see yields are going to go to the moon. Maybe, all right? Maybe not. We'll see. Uh, it's not something that can be judged with just 1 month data point, all right? Finishing off with the unemployment claims, which had this. It looks like a huge uptick if you just look at a chart like this, but if you zoom out a little bit and you include a bit more of a time span, and if you check from 2022, right, we are still right in that range, right? So what's the magic number? Should be around 270K. I mean, if you look at it as a proxy for unemployment, uh, up until the point these claims don't start to break above this magic number, this imaginary trend line, right? I wouldn't say it is concerning. There are many other things to be concerned of, but as for this week right here, right now, unemployment claims, not yet. right? So let's have a look at the charts, starting out with currencies and trying to be particularly brief on the first part of the charts, right? So I included the dollar Canadian and the Swiss franc. You might wonder why, just for the sake of it, to be fair, just for a change, since I always got the same type of quadrant, right? So just include two more, just to look at the same thing, or which is basically the DXY going up and the others being smashed. Now, of course, as usual, for the yen, the dollar Canadian, and the Swiss franc, these charts, these three charts, one, two, and three, those are inverted because the dollar it's at the numerator in these crosses. So in order to match what the euro is doing and what the British pound is doing, you need to invert those ones, right? Now again, it's a little it's a bit more of the same it was before. Nothing really changed when it comes down to currencies, for better or worse, right? We're still looking at dollar strength, and all the rest it's hammered a little bit. Now the yen, of course, is the one which always catches the attention because of the yen carry trade and whatnot. It pulled back a lot after the breakout off of this trend line, right? But I mean, this is just Fanta TA, right? But could this be some sort of a fractal, right? I mean, if you check this major trend line right in here, we broke out massively, and then we spent basically almost 2 months drawing back, getting back near to the breaking point. Now, if you zoom in, if you try to imagine a fractal behavior like that, we got this trend line, we broke out, we are now coming back down to retest the breakout point. Could this be? Maybe, maybe not. In this case, I wouldn't put a lot of weight into it. I mean, from a structural standpoint, would still be some sort of a base, so maybe a little bit of a stalling, or a tiny bounce. We'll see. As for now, I find particularly difficult to bet against the US dollar against its peers, but yeah, anything is possible, right? So just just keep on looking at it and see what it does. Same for the others, right? But other than that, I don't really see something which has substantially changed in currency's behavior. Let's check gold, which is another one but that basically did fuck all. I mean, yeah, got this massive spike, starting off with Monday, Tuesday, Wednesday, and then Thursday reversal, and we closed back down basically at the weekly open, right? If you zoom out on the weekly, should be a doji, yeah, long leg doji with a shadow particularly pronounced to the upside. Still, a lot of people were calling the top in gold, at least for 2024, which, to some degree, let's say it leaves me a little bit split. Like, to some degree, one of these guys calling the top in gold was Chris Lurie, and I can't discard his judgment absolutely. On the other side, coming in, calling the top around November. Uh, yeah, I mean, and then it goes into a consolidation, and we are what 2 weeks away from the new year. So saying this is it for 2024, yeah, no shit, Sherlock. We're a month of trading, and with a market which is particularly overextended, it's not unusual to expect at least a little bit of a consolidation. Although, I saw charts of gold with arrows pointing back down to the 2000 level, 2200. Uh, if you remember my last videos, I was like, yeah, maybe premature, right? It could happen. I just don't think it's gonna happen at the rate and at the pace those charts were suggesting. But all in all, gold, it's still, you might say, still trying to grind to the upside, right? But at least for this week, didn't manage to break out of this range. Actually, we're still around the EQ, believe it or not. Okay. As for oil, another market which has been particularly boring as of late, another bounce, and we are still back in this range. Came off from range low up to range high. So, at this point, I'm kind of losing my hope for oil to give us some sort of a story to really talk about. If you check the break evens, they basically followed the bounce. So they were coming back down, now they're back up. Yeah, you might say, yeah, but maybe gold is moving now to the upside, at least this week, on the back of what was the CPI report. So, higher inflation, that that would be a higher oil prices, right? Uh, I mean, I would agree with the concept as a whole, right? It's normal that if you're gonna have higher inflation, one of the main contributor or contributing factors should be the price of energy and therefore the price of oil going up. But I mean, if you check the dates, this bounce basically started on Monday and it was just up only for the rest of the week. It's not like it was going down, we got CPI print and everything reverses to the upside. So I don't think it was news driven, to be fair. I just think it's following the same path which has been followed for really the last, at this stage, 2, 3 months. So I wouldn't read too much into it. I wouldn't try to overcomplicate that, right? Bitcoin, again, another one which everyone were calling for. The top is in, the top is in. We hit 100K. That's the psychological level, and now we're going to pull back. Yeah, I mean, as I said, it could or it couldn't. As for now, it didn't. Actually, again, if you remember, it looks like it's keeping up this grind to the upside, same as what we've seen. If you remember, we took this example right here, right? Kind of the same behavior, major breakout, grinding to the upside with no major pullback overall. So as for now, I'd say it's still good for a bit more of upside. Of course, everyone is kind of trying to wrap their heads around what's the terminal target before the next huge pullback. And when you talk about Bitcoin, if you really mean some sort of an important pullback, you're talking like 25-30% at the very least, right? Uh, I think we're gonna trade at least up and around 110, but I'm not even sure we're gonna see a pullback from there. Uh, to me personally, it's way easier to assess what the equity market, namely the S&P, would likely do, and then try to extrapolate that forecast over onto Bitcoin. Because at the end of it, I keep on thinking they're both risk on assets, and the main driver for their behavior it's still liquidity and global flows. So the way I see it, instead of looking at a chart of a chart of something which is particularly volatile, I would rather look at what the overall market is doing and then assess the risk of a potential downturn or major pullback for Bitcoin like that. Uh, it's not like you cannot do it by just looking at Bitcoin and the structure. I mean, yeah, of course. The problem I see with it is that if you see it, let's say, breaking structure from the current levels, just hypothetically, right? I'm not saying this is going to happen, but just to kind of express my, quote unquote, difficulty in assessing Bitcoin. If you see it dropping and breaking structure, that would mean you would at least need to trade below this low, right? And potentially breaking it with a little bit of a momentum. And at that point, let's say you already lost what? Um, 10%, which for Bitcoin, it's not even a huge type of a move. So you could say, yeah, I mean, I got the big run up. If I'm not selling the top, but I'm selling 10% below it, is it bad? Well, overall, is it? You'll be the judge of it. But if you got, let's say, an average purchasing price in the middle of this consolidation, if you sell it when it breaks the low, you're still making what, a 40% return? Yeah, you didn't make 60. Oh, gee, I didn't make 60. That's awful. I mean, I must be stupid. I didn't sell the top, but at the end of it, who the fuck cares? So yeah, just a little bit of a rant on these urge of calling the top on pretty much everything, to be fair. So just relax. I mean, it's all cool for now, right? Now, let's get into the nitty gritty of the week. CPI, inflation, and therefore yields. Let's start out with bonds, which, of course, if you look at the major ETFs, they were crashed this week. And actually, uh, I added a little bit to my TLT position 2 weeks ago, basically when we broke out of this wedge. Now, you can't really see that because you would need to zoom in on maybe the 4 hours or the 1 hour time frame, but there was a gap which was basically filled and failed to reject. And I said, you know what, I'm going to add into it. I guess if you go back to last week videos, you're going to see some sort of a line into here. Yeah, that was the level where I bought. Um, but last week we also discussed these potential first trouble areas, right? Now, for reasons of, you know, keeping the charts clean, I erased a lot of the lines and levels I got in here, but they were basically all potential levels of attention and potential rejection of struggle for price to keep on going higher. So after seeing the rejection in here, and especially the failure at new highs, so keeping on shifting the structure on a much more deep swing like this, right, on the TLT, and then I saw it coming back down, and basically we broke these low on news because it was on Wednesday when the CPI was released. And at that point, I said, you know what? Yeah, my long-term thesis might be whatever the fuck you want. The problem is, I don't want to lose money in the short term just because I'm expecting, this shit to maybe go up over the next 6, 9 months, right? So I just closed the position. I I was lucky enough to have 1 and basically 2 days before going underwater, and so yeah, so far I keep my original allocation on bonds, which is a very long-term type of allocation. I mean, uh, my other purchases were in here and in here, so I'm still monitoring. I took a lot of profits on the run up. I guess you can see in here, those axes are basically where I booked in the profits, right? And then I added back in, or I took profits again, and then this time I tried to add back in, and it didn't play out. So, when a trade doesn't go in your favor, it doesn't mean that your long-term thesis is necessarily wrong. It just means that probably that wasn't the right time, right? So instead of losing your sleep over it, just close down the position on in this case the incremental position and live with it, right? There might be a better time to add back into bonds, but clearly if you look at what the market is doing right now, this is not the time. So just don't try to fight market forces, because it doesn't matter. Even if your macro thesis is going to be right over the long run, it really serves no purpose if you're fucked and wrecked in the process of getting there. All right. So let's check the yields, which of course they seemed like a top, but then we got this week with the CPI and the PPI coming in, and they just reversed completely and went to the upside. So if you zoom out a little bit, let's go with a weekly time frame for a moment, right? So if you look at it like this, is it a massive problem? Well, not so far. I mean, up until the point we start to crack the 5% level, probably not, but uh, definitely it is something to pay attention to, all right? Uh, could we go for a massive double top? I don't know. The problem with it is that the ebbs and flows in the short term would would crash you, as I said before, even if eventually your long-term thesis might be right. Okay. So as for now, I got back to my original allocation on bonds, which by the way, it's really not a huge amount. Um, a lot of it's in gold, to be fair, and I still got my US cash. And believe it or not, money market funds, because at the end of it, uh, having 4.5% returns basically for free on short-term bills is not bad. Of course, it's not as good as being in the stock market and enjoying a 30% type of return year over year, but considering my risk aversion and considering the fact that at the end of it, gold performed particularly well, so I'm not really banging my head against the brick wall for not being in stocks or in Bitcoin for what it's worth, right? Now, I got a question and I actually didn't know how to answer, right? It was basically, why do you think that yields actually started to run up immediately after the Fed started to cut? So, as I said, Roman, I didn't have a lot of time to dig into it. So I guess, the first explanation that I gave out was it was priced in, right? It was a sell the new event. Because if you check, let's say, the TLT and the other bonds, ETFs, if you check the dates, starting the end of July, but particularly the end of August, the market started to ramp higher. It's just a rampage, furious rampage, all right? And at that point, if you remember a little bit of the narrative, it was clear, quote unquote, that the Fed was about to cut. Um, Not only for macroeconomic reasons in that particular moment, but if you remember, there was a huge controversy around the July meeting, and the public was a little bit split. Yeah, Jay Powell should have cut in July because then he doesn't get the chance to cut in August, and so he's gonna be behind the curve. And long story short, what we've seen is that he went for a 50 basis points cut in September because the mainstream explanation was he would have preferred to cut 25 in July. It didn't because he didn't have the how do you call it, unanimity or unanimity? What was that? Well, basically, not all of the members of the board were in agreement with him. So he decided rather than taking a decision which was a little bit, you know, we faced a bit of opposition, even inside his own board, he decided to wait a bit and then cut 50 in September. But since this narrative was built up all throughout the summer, when we came in and bonds were particularly extended and overbought to the upside, we got a sell the news event. So that was the explanation that you got for the sudden crash, so to speak, in bonds right after the first rate cut, right? It is a mainstream explanation, and quite honestly, although I usually try to run away from the mainstream media, but this one, it's actually an explanation which resonates a lot with what usually happens in markets. So to me, it could be a good explanation, and it could explain what we've seen in here. Now, there are many other factors. Absolutely, there are many other, again, narratives which people are coming up with, and I recorded that video about Paul Tudor Jones, right? Um, I guess what I did after you asked, it was let's check the main benchmark for yields and interest rates in the US, which is the 10-year yield. Let's see what we got since the moment the Fed started to cut. Now, on the top panel in here, you see Fed funds, right? Just Fed funds right in here. And the red one at the bottom is US inflation rate year over year. So basically CPI year over year, right? For Fed funds, in order to draw these lines, which represents the initial cut or the beginning of the cutting cycle, I defaulted back to this essentially. If I can bring it on the screen once again, assuming I still have it because I don't know. Let's see. Yeah, actual Fed data. So you got the dates of the first cut for this period, so the latest cuts. I should have it for the what was that? 2019, 2020 cutting cycle. And this is, wait, no, this is actually 2007 or 8, sorry. And the dot-com bust in the 2000s, right? And this one was actually pre-COVID, 2019, 2020. So that's what I did in order to grasp the dates and be accurate on them. And then I checked and I said, yeah, so from the first cut, I'm using candle opens, right? Just to try to standardize a little bit the measurement, right? So it went up, the 10-year yield went up, what, call it, zoom in, call it 70 basis points, more or less. Could it go higher now? Maybe. In that case, we will adjust the chart. And inflation came a little bit back up from what it was when it went down to 2.4 and it came up to 2.7 really. So not a lot. But so the question was, is it normal? Or is it such an anomaly that you see the Fed actually starting to cut rates and the market going completely the other direction? Hmm. Well, first of all, I said, well, let's see. But at the end of it, if you check Fed funds, right, we've seen the Fed staying higher for longer, around 5.25%, and staying flat at that level for basically the end of July 2023. Now, end of July 2023, it was basically, where was it? In here. Yeah, that's the beginning of August. So it was in here, let's say. Let's just try to mark that out with something which is not white, for Christ's sake. Yeah. So it was in here. So yields actually kept on going higher, and the 10 years yield peaked out, topped out at and around, call it 4.9, but yeah, rounded up to 5%. Right. So basically in line with Fed funds, more or less. If it is particularly strange that now that they are cutting, the market is going up as for the yields, why wasn't it strange that while they were staying higher for longer, the 10-year yield went from 5% roughly down to 3.8, 3.9, call it what you want. So you see, that move seems very controversial and counterintuitive, but why weren't people asking question when the Fed was staying above 5% on Fed funds, and the 10-year was going from 5% down to 3.9, so basically losing 100 basis points, right? Nobody was asking question. And it was even worse because we got a secondary drop, right, from here, where it went down to 3.70, 3.65. So again, the ebbs and flows sometimes can really throw you off. But I guess the process should be the same. If now this is strange, why wasn't it strange when something like this was happening? Right. So that was the first thing I kind of saw, and at the end of it, now Fed funds is around 4.5, so to speak. Shit, is it? But is it up to date? Because sometimes these indicators on TradingView are not really up to date. Let me check a little bit. Fed funds. Because I don't. Let's check this one. Yeah, target range should be 4.5, right? Just to double check. I mean, right? So and the 10-year is around 4.4, which is basically the same type of spread that you got while the Fed was higher for longer, right? So is it normal? Is it not normal? 5.25, and we got 4.9. So a little bit of a spread, but what, 20, 30 basis points, right? And then now you have 4.5, 4.4. So 10 basis points of a spread. I don't see it as a massive discrepancy, to be honest. So again, it looks like where yields goes, the Fed follows again. So that was the first consideration. The second one was, I wonder if we didn't see something similar in the past. So let's go check it. So this is basically the 2019, 2020 cutting cycle right before the pandemic. And by the way, these red shaded areas, those are US recessions. All right. Okay. So even in here, you see that the first cut was in 2019, and after that, we've seen, I mean, a little bit after that, because right, 1, 2, 3, 4, 5 weeks after that, so not an immediate response, but even in here, we've seen some sort of a 50 basis points type of a bounce, and still using closes. So if you use shadows, it could be even higher than that, even wider as a move. So it wasn't as big as 80 basis points we're looking at right now, but still we got a little bit of a counter trend move throughout the Fed cutting cycle, right? Then of course we got the pandemic and everything, all hell broke loose. But this is one of the things, everyone is calling the pandemic a huge anomaly. Therefore, they are oftentimes leaving out the data from this period of time because it is too skewed one way or the other. So it's a big outlier, right? Yeah, I might agree with that. But overall, there are many different things I look at, and I still think, although the pandemic was a little bit of a black swan, was it really? Because if you look at the inversion of the curves and many other different macroeconomic indicators, it looks like they were all pointing to a little bit of a downturn. Now, sure, the pandemic obviously exacerbated everything, because you can't say it didn't influence shit when you lock down everyone in their house and you shut down the global economy, right? But again, even in this period, you've seen a little bit of a counter trend rally in yields, although the Fed was actually cutting back then, right? Then what we got, I'll assume we get back to 2008. Yeah, so in 2008, the Fed started to cut in September. Curiously enough, September the 18th, kind of like now. Now it doesn't really mean shit. It's just because they started to cut at the same exact date, it doesn't mean that we are going to see another 2008. But we got a counter trend rally in it. Yeah, I mean, 100 basis points, 98, rounded up to 100. All right. And ultimately, the yields actually went down like a lot. right? What's curious about it is that they started to cut, and when they started to cut, if you check inflation, it was what, right around 2%, more or less. Could be 2%, could be 2.2%, whatever. They starting to cut, inflation actually accelerate to the upside, peaking up at a 5.5% when July 2008. Mind you that September 2008, Lehman was forced into bankruptcy, and it was looking like the end of the world, the biggest financial crisis in history, right? So, I mean, and yet in that process, we got 100 basis points type of a counter move in yields. Hmm. In the dot-com bust, they started to cut in January 2001, and throughout this period, although not really the moment like we've seen now, the moment when they started to cut. I mean, we already have a little bit of a pop the week they started to cut. What was that? I don't know, 40 basis points, right? So it's not huge, but the big one was a bit later on in March, and we are talking again almost 80 basis points of a bounce in the 10 years yield, while Fed fund is going down and inflation stayed well, particularly stable. So, but if you check, even in here, if you check the yields, they topped out while the Fed was still, let's do it this way, right? So it's, yeah, the Fed was still hiking rates, and yields already topped out and started to invert the trend, lower high, lower low, lower high, and the Fed it's still going for the hike, right? So again, what you want to read into it is, by the way, even when here it wasn't that pronounced, but kinda, not really, but kinda. So what you want to make of it, right? Well, it is just 20 years of history, and we are just looking at three, and I want to say four if you include the cutting cycle we are in now. So not a huge data set, right? But recent history, um, 25 years, three iterations of it. Uh, my conclusion was it can happen. It's not really an anomaly. It's something that can happen. It happened. So would I be worried just because I see yields going in the opposite direction compared to what the Fed would like to do and actually is doing and would like to transmit as forward guidance to the rest of the market? That is not the thing I'm worried about, to be fair. All right. That's not it. Okay. So I don't know if that answers your question. If sorry. Yeah, no, if that answers your question. Yeah, yeah, yeah. Said it right. Yeah. But I mean, at least it shows you that it's not something completely unheard of or completely unusual, right? So I'm just gonna leave it at that, and you might make with it what you want, or you might dig a bit more than what I did. Maybe you're coming back to me. Uh, I hope you're gonna say, "Yeah, I found this other one. That is another factor. You didn't see that, yeah, because I like that." Now, all right, just it's not like I'm recording the whole video for Roman, but that question, I guess it's the question that everyone kind of had it had in the back of their mind, right? Because it's controversial, it's counterintuitive. You wouldn't expect that, right? Up until the point you start to see it can actually happen, and it didn't. It actually did happen in the past. Um, Keep on staying on the argument of yields and rates and what and inflation, of course. I've seen once again this theme about the money on the sideline, right? Sometimes it's about the repo market, sometimes it's about money market funds. So since people are keeps keep talking about it, let's check a little bit, right? This infamous cash on the sidelines, right? Now, um, so it looks like money market funds are kind of going up. Now, this chart actually, I admittedly I took the wrong one. There was another one which was including 2024. Hopefully we hopefully I got another one down the road. But anyway, it shows you that the core concept is that when you see money market funds going up, oftentimes it happens ahead of recessions. And why? Well, because it shows you that it's not a bad time to hoard and hold cash. Cash is not trash, right? Um, so this is basically a function of interest rates to some degree, right? Because if you check, there are periods in history where you might have positive real rates or negative real rates. Now, the green shaded area right in here, it's the positive delta. So the positive difference in between where the 3-month treasury bill is and where inflation rate, of course, is measured by the CPI, and the CPI is a shit of a measurement tool for inflation. All right, but at least we need a benchmark. We need something to make an analysis off of. And anyway, whatever what you think about CPI, the market is going to move off of the CPI data points, right? So it doesn't really matter what you believe is fair or it's not fair. If the market is moving based on this one indicator right here, you're going to follow it because otherwise you're going to be wrecked, right? Usual disclaimer about the CPI, all right? Now, of course, sometimes we got negative real rates and sometimes we got positive real rates. That is just some sort of a cycle, right? And it depends on what yields are doing and where the rate of inflation is moving around. Okay. Now, what is cool to notice is that when you got positive real rates, of course, um, money market funds tend to be appreciated because, well, I mean, my savings can actually yield me something. So if I do save, it's actually good before I'm actually getting a return on my savings. And by the way, I can avoid the risk of being exposed to some other volatile asset. Maybe I'm not going to get the same type of returns, but at least my savings are not staying there, just being eroded by the rate of inflation, right? And that happens again right ahead of recessions. In recessions, you got, or at least in the midst of recessions or right after them, you got the opposite phenomenon, which is money market funds see an outflow. Why? Well, I guess probably two contributing factors. One is that allegedly in a recession the Fed is gonna smash rates back down, so the incentive in having your money in a money market fund which were yielding, let's say for now, 4.5%, 5% something, right, on the short duration, if that evaporates, right, you're not going to be incentivized in keeping your money in money market funds. Plus, on the other hand, you might get into that dynamic where people are actually going out and basically rotating that money and starting to buy actual stuff, financial assets. By the old logic, you need to buy when there is blood in the street. So, it's kind of like Warren Buffett is doing right now, or at least it looks like he's doing. He's sitting on a massive pile of cash, and he liquidated a lot of his long-term holdings in stuff like Bank of America and Apple, as strange as it might sound, because, well, obviously he doesn't think that stock are a good investment for now. Now you might say, but at the end of it, the S&P it's still going higher, right? Yeah, but he's also looking uh, at the fundamentals in a way where he's looking at the earnings. So when in his philosophy, when you hold a stock, it's not only for the price appreciation, it's also, and a lot of it is because what type of return it can give you in terms of the yield, sorry, the earnings, which is able to generate. So the dividends, right? I mean, this is Warren Buffett. I already disputed Paul Tudor Jones. I'm not going to dispute Warren Buffett. So we are we're gonna take it for what it is, and this is what it's doing. But basically, when there is negative real rates, it's either the Fed, which is dropping them, or of course, in a recession, inflation and future inflation expectations and growth are going down, so yields are going to follow it, and you lose the incentive of being in a money market funds because you're not compensated as you were before, right? Now, here is interesting. Now, I don't really get the full point of it. Like, I mean, I would see why you would keep your deposit in the bank throughout this period, right? But I mean, I guess the huge run up in this chart is not only a testimony of yields and inflation, which went down over time, but also because we got more money into the system. So naturally, the balance sheet of all the commercial banks expanded. It's just a little bit of an aside for me. I wouldn't particularly take this into account when it comes down to assessing the risk in financial markets. I mean, I'm not saying you should completely discarding it, right? It's the same old thing, right? If you're willing to keep your money into your banking account and you're very well aware that they are going to lose against inflation, what might be the reason for it? Well, you either see inflation not being humongous, or you might see actually disinflation or deflation, or you just think that there is no other better alternative when you make a risk a risk adjusted type of analysis. There is no alternative out there to deploy your capital in. So at this point, it's better to keep them into the bank, right? You could look at it like this, and it would make sense for me, but I'm not paying particular attention to the level of large deposits in commercial banks. At least I never did up until now. Should I start to do it? Maybe. Who knows? Now, getting back to real rates. As for now, they are, of course, positive, and therefore you are incentivized in keeping your money in money market funds. But again, as you can see, every time they are positive, what comes after is usually a downturn. Now, here's uh, a comparison of this dynamic we've seen into here with the behavior of the S&P 500. And as you can notice, there are periods when real rates are actually positive and the S&P is performing very well. So just because you see real rates being positive, it doesn't mean that you're going to expect a crash in the equity market tomorrow, right? But inevitably, at a point, that downturn is going to come. Curiously, they both go down together. Probably my best guess would be the same dynamic as before, right? Disinflation, deflation, growth going fucked, and starting to deploy capital to buy stuff on a chip, right? At a huge discount. Could this be, right? The situation we are living in right now, it's kind of the same, right? Real rates, positive, stock market going higher. Now, here we bring, well, the article brings in another factor, which is uh, employment. Now, in this case, we are talking jobless claims, right? So it looks like this situation where the stock market keeps on going higher can be sustained up until the point employment it becomes a problem. Because as you can see, when the jobless claims start to tick up, you got a top in the equity market, right? This one wasn't highlighted. I added this shaded area right here where you see the jobless claims starting to break out and the S&P it's starting to put in a top, and that was '08, of course. Now we are not really in the same situation right here right now as we have looked at if you remember the magic number in here, right? Where was it? Yeah, it was here, right? We are not breaking out off of this level so far, right? So we are not really there standing to this logic. Could we go there relatively quickly? I mean, unemployment is usually the last shoe to drop when you talk in recessions. And usually when it happens particularly quickly and violently. So I guess at the end of it, keep on monitoring these labor data. It's always useful because they can give you a hint of what could come. And it could come particularly sharply. So just bear in mind that. Now we got the comparison with unemployment. And again, you see that when real rates transition from positive to negative, you got unemployment skyrocketing to the upside. Now, what's interesting about unemployment and the jobless claims, which are oftentimes used as a proxy to extrapolate what it's going to be unemployment down the road, what's interesting is that if you check not only the simple data point of jobless claims, but if you also add the 20 plus weeks unemployed type of data, what you see is that we are maybe in a similar environment to what we have seen ahead of every single recession of the past 50 years. So these yellow lines just add a bit more of an insight in the whole phenomenon, right? So the the main talking point here it's the the cumulative, so the continued claims plus the 7 plus weeks. I mean, if you sum them up together, it gives you some sort of a different read compared to the continued claims alone, because you know the uptick in the cumulative aggregate, it looks a bit sharper than if you just look at the other two in isolation. So could this be another type of insight in the quote unquote fragility of the labor market? I mean, yeah, it could, right? So that was it for bonds, yields, and whatnot. And overall, my base case, it's still for the long term, we are gonna have rates getting down. But it's gonna take a while, most likely, and I guess you will need a catalyst for it. So just as it's gonna be a long one, I already know it. But as an example, I got this sort of a recap, right, for the current week. Now, of course, you're not gonna be able to read it. I posted it, but it was sometimes it happens, right? An Italian server. Now, really quickly, bonds had a very bad week. Okay, so the potential factors for it, of course, CPI and PPI, which surprised to the upside. But I wanted to bring it up because there is something that not a lot of people are talking about, at least not the people that I know or in the environment I'm usually in, which is loss harvesting for fiscal reasons. So, a lot of people are attributing these moves in the yields to, the market is looking at the macro data points coming in, depicting an economic picture which is rosy and possibly a reacceleration of inflation. And of course, the bond market is asking for higher returns in order to lend the money to the government because, there might be better opportunity in other sectors of the economy. And of course, this is always it goes hand in hand with the usual fears and the usual suspects, the deficit, the debt, and the foreigners which are actually starting to dump bonds and rejecting U.S. bonds, right, treasuries, and of course the theme of de-dollarization. Now, the third cause, at least in the short term, it's not to be discarded because it's just a matter of a time of the year. And at the end of it, the logic is particularly simple. Before end of year, if you want to have tax deduction, you're going to sell the assets which are actually underwater because the way you are taxed on capital gains is that you pay on what you gain, but you can subtract, you can deduct the actual losses you had before applying the rate of taxation, the percentage and whatnot. So if you're getting near to the end of the year, why wouldn't you sell the the underperforming, the losers? In a way, you could. It's not really that, but in a way, you could see it as, look, I'm underwater, so I'm already losing money. But if I sell and I actually realize the loss, I can deduct it from my income statement and I'm going to pay less taxes. So it could be somewhat turning a loser into a winner. You're going to lose on the investment, but you're going to pay less taxes to the government. So, which is why something like this might happen. The good thing is, well, the funny thing is that, you know, if you need to run a portfolio over the long run and it's a balanced portfolio, it could be an 80-20, 60-40, something like that. Overall, you need to have that allocation to those bonds to keep the portfolio balanced, right? So what you do is basically you sell them for fiscal reasons near end of year, and then you buy them back after the first 2 weeks of January. So at that point, you need to wait 31 days in order to be eligible for the fiscal deduction, right? And then you can buy them back in order to keep keep on your allocation into balance. So it could be a little bit like that, or it could be a contributing factor when you see bonds being massively crimped right ahead of year end. I'm not saying that is all there is, but it could be an influential factor. And among these three, I think this one, the third one, actually, in the short term, the very short term, it might be the most important, right? And that, going ahead. So at the end of it, do we really have an inflation problem or not? If you look at the fundamentals, no, it is just simple. No, as I said in my video about Paul Tudor Jones and his thesis, the trend for inflation right now it's still to the downside. Now you might have these ebbs and flows on a month-over-month base, but at the end of it, if you look around at the macroeconomic picture, it tells a different story, not only in the US, but for the rest of the world as well. You know, if you check, for example, Europe or Asia, right? Uh, they are seeing an economic slowdown, and it's quite unusual in an economic system or in a financial system which, whether you like it or not, or whether you think globalization is over, this system it's still very much interconnected. So it's particularly naive, in my view, to think that Euro, Asia, everyone else is going to suffer a downturn, and the US are going to keep on growing at 2.5, 3% GDP. I see it a very low probability scenario. So I'm not saying the US will have a 2008 crash, but at least a slowdown. If the rest of the world is slowing down, it should come in the US as well, right? So no matter all the advantages that the US might have compared to the rest of the world economy, well, I'm basically repeating what I just said. It's still interconnected. So it's naive to think about the US being the only rosy environment and happy island without following the fate of the rest of the world, right? It's just a function of time at the end of it, okay? So at the current moment in time, as we've seen in the chart, and as I told you about my addition trade attempt, it's not a good moment to be long bonds, right? Um, so it's very important that you decide since the from scratch since the beginning if your trade is going to be short term, medium term, or if you want to have long term positions, right? Now, since at the moment there are not real fundamental reasons to imagine higher interest rates in a very sustained way over a long period of time, what could invalidate this thesis that I got in order to say, you know what, I was wrong, and I think at that point rates should really go higher. We are really going to have not an inflation problem, but at least inflation which will be sustained at a higher than expected level, and therefore I don't want to be in bonds anymore. Well, um, let's say Trump. steps into office with the new administration, and one of the first things he does is approving or launching uh, a reform or a bill which introduce massive public investment in infrastructure. So let's say you in America, you want to restructure the power grid or build up a lot of utility companies or invest in nuclear facilities, right? At that point, I don't think being in bond would be a good pick. At least the long duration bonds. Why? Well, it's the same I always discuss with Anthony, because at that point, what you might want to do if you need to balance out your portfolio is being in the bills, so very short term, right? But you're not gonna have huge returns on the long end because the long end is gonna price in higher inflation expectations and growth expectations if you go with these type of measurements, right? It's kind of like some sort of a project like the Hoover Dam, right? If you check history and you look at the amount of return of investment the Hoover Dam actually had for the region of the states where it was built up, it was it was substantial, and therefore that's the real kind of growth and investment and capital allocation you want to see by the government. Now, as I said, all those type of interventions will bring in inflationary conditions that can be sustained for the long term, medium to long term. You would create new jobs, you would spurge economic activity, new payrolls, and new potential aggregate, well, I said spending, but basically, aka aggregate demand. All right. So again, no cool for the long duration bond in this case. Now, a lot of people are actually forecasting change in the trend, in the long trend of interest rates. You got this secular trend, right? But the problem with that is that you would need to change the fundamentals of the economy in order for that to be possible. All right. Uh, I feel like there is a big of a misunderstanding or a mistake that people are actually stumble upon right now, because they look at the over the last 3 4 years after 2020, and they see the economy held up relatively well compared to the rest of the world, right? But and therefore they extrapolate this recent uptick in economic growth as for GDP, for instance, and the stock market as for market returns, and they think it's going to last forever because it worked over the last 2 3 years. So it got to work forever. But you need to remember that these growth that you've seen, especially in the US, it's not an organic growth which came in from a very sound and good economy, and it can be brought on and carried on in a sustainable way, right? Everything that came in was the result of the government and the public sector floating the economy with fiscal moratoriums, student loans forgiveness, up to sending steamy checks directly into citizens' mail post, right? And throughout the pandemic, everything was cool and everything was dandy. At the end of it, the government actually caused the downturn by locking everyone in, so they needed to come up with a response in order to not get a revolution, right? But can it work? The same rate of growth and the same rosy economy can be sustained if all these stimulus slowly start to run out and being dragged out of the system. It's like the mouse in the python, right? I don't think it is. I don't think it is sustainable. And I don't think, unless you're going to see something like what I've said above about infrastructure bills and government spending in productive investments, or you get back to a playbook where you got another Inflation Reduction Act or another CHIPS Act 2.0, let's say. If you don't provide the liquidity, slowly but surely, what is currently present in the system, it's gonna, you know, evaporate at a point. And just mind you, as one last act of his administration, I've read Biden actually allowed the deployment of more money, which were actually, included in all these interventions like the CHIPS Act and the Inflation Reduction Act, but they weren't spent yet. So again, this liquidity could keep on roaming around the system for a bit longer, but unless you intervene with some more type of quote unquote stimulus like those, it's gonna go down, and so goes liquidity, so goes financial markets, and so go real economy at a point, in whichever order you want to pick. I'm not really prioritizing one over the other. I say that everything starts with liquidity. All right. Now, one of the main objections might be, yeah, but if the government, let's say we go for these infrastructural investments, so people might say, well, but if the government is financing those infrastructural bills still with deficit, we are just adding fuel to the fire. We are just exacerbating the problem. Well, not really. I mean, it's not always the same story. There are there is a key differential in here. If you keep on spending, all right, you need to check what type of spending you're doing. Because if the government spending, which of course is done through deficit spending, right? If you finance non-productive investments, then you got the same situation you've been in for this long period of disinflation and slow and stagnant economic growth. All right. Now, of course, in the middle of it, you might have a few spikes in inflation here and there for the reasons XYZ. It could be geopolitical, it could be the energy market, it could be a war, it could be what have you, right? That is just because you got more debt, less future growth, less inflation, lower interest rates, because the deficit has a negative multiplier. And again, it all gets back to what I said about Paul Tudor Jones, right? So instead, if the public spending is actually going into investments which are producing a return, or they are generating a utility for society and the nation at large, or the rest of the economic system, over the long run, that spending is going to be paid off on its own. Right, for many different reasons. It could bring you a better efficiency, it could bring you less waste of resources, or uh, if you got economic activity, sure, the government is going to have more fiscal revenues, more tax revenues, right? Because more jobs, more payrolls. On each payrolls, you pay taxes to the government. So productive investments, when it comes down to the public sector, should be what could really drag you out of the hole you digged yourself into over the last 30, 40 years, actually starting from the 80s when the deficit started to skyrocket higher for non-productive investments. So uh, again, in both cases, the deficit is going to go higher, right? The difference is that for not productive investment, it's going to go higher, and it's going to keep on going higher without generating a huge return or a huge benefit for the nation and the society at large. In the other case of productive investment, it's going to go higher in the short term, but the situation is going to be way better over the long run, right? So that was it when it comes down to inflation, yields, and a little bit, why not, of government intervention. Because let's face it, we live in a system where the government, whether you like it or not, it's really intervening in the economy too much, in my view, too much. So since we are really going to record probably the breaking the record of the longest video, um, let's check stocks. All right, because there was one thing I want to look at it for stocks. I normally don't do that, but this behavior was just too good in my view when it comes down to uh, intra week, so short, lower time frames, so to speak. I mean, it's still a daily time frame, but anyway, if you check, you got Nasdaq futures, ES futures, and the Dow. Now, first of all, look at the relative strength, which is something that I always monitor throughout my day trading, not only on a daily time frame, but still even on the hourly time frame, the 15 minutes and whatnot. So you see that these two markets, NQ and ES, one is making a higher high and the other is making a lower low. So you already know which one is the stronger and which one is the weaker. And what you know, which one is the market which is making a higher high and which one is the one which is making a higher low, right? But what was really funny about this week is that on NQ you got this little bit of, if you are familiar with patterns, right? This little bit of a head and shoulder which was printed, and let's try to zoom out. Yeah, just zoom in on NQ alone. It was printed on the charts. Then you got the breakdown. So it's like, yeah, the pattern has been triggered. We are gonna go down now. And you can extrapolate the expected measure move, measuring the distance from the neckline to the head, right? So we are gonna get back into this base now because that's what the measure move is suggesting. Really, no, because you bounced back really into the gap below, almost testing the midpoint of it. And the best thing of all is that you came back above the neckline. The day where inflation CPI was released, we at the open of the American markets, you are already trading at and around or very quickly above the right shoulder. You invalidate the pattern and you got the same measure move, but which is now applied from the point of invalidation up to the levels we traded up to. Now we had another spike on a Friday, but on a closing base, that was literally the top for the week. So that was the first thing. I never talk about, you know, real technicals in these videos. So I felt like when there was something particularly good to look at, why not bringing that in, right? And of course, the rest it's always the same. Throughout the week, I was discussing with Anthony, and I'm gonna butcher the name, so apologies in advance, my good friend. But I guess it is pronounced uh, Modi, Modi. Sorry, I don't know, but our friend from Northern Europe, right? And we were looking at the different markets, right? And the question was, uh, rotation. You're not gonna see a top in equity markets up until the point you see a huge rotation from the big caps into the small caps and a parabolic blow off top in small caps, kind of like what you see in the crypto market, right? You see Bitcoin goes up, then you got all the shitcoin going up, and you know Bitcoin tops out, shitcoin went goes just parabolic, they tops out, and now you know that that's the end of the cycle. But my only problem was, yeah, but if you look over the last 3, 4 years, small caps massively underperformed. So why should one expect they're gonna have a parabolic blow off top? Now I'm not saying they won't have it or they couldn't have it. I'm just saying, assuming you are an intelligent investor, right? Why would you pile in on something which historically always underperformed the rest of the market? I don't see it. Unless, and I could agree with that, you say, yeah, but parabolic blow of tops, the people which are buying into them are often, people which are coming in at the late stage of a bull market, people which are FOMOing in at the top, so retail investors, people which are just uneducated. Because when you see your neighbor which is making huge money and you are not, and you know that he is involved in stocks, you might say, you know what, I want some of that too. And as usual, you end up buying the top. Yeah, I could agree with that, but I don't necessarily think we need to have a parabolic blow off top in small caps before seeing a huge downturn overall. Just that was just a thought. Um, as for the ETFs, we got a little bit of a pullback early in the week, as you can see in here, right? A bit more pronounced on the S&P. but they both came back a little bit, kind of retesting the old highs on the Qs. Oh, same on ES or SPY in this case, and kind of reverting a little bit back to the faster exponential moving average. Um, will they keep on rallying? I would say I would lean toward yes, but probably I don't know. I just wait for the first three, yeah, maybe 3 days of next week. After Wednesday, if you're gonna see the Santa rally, it should be starting. Because for the next 3 days, three trading days, I would still expect a little bit of that portfolio rebalancing stuff we were discussing about last week, which incidentally was the catalyst for this little bit of a start. If you remember, I called for a starter step, potential drawback toward the moving average, right? Which is kind of what we got. Could we get a bit more of it? Maybe at least Monday, Tuesday, yeah. But overall, I'm still kind of positive on the Santa rally to manifest itself. Um, Look, if it doesn't, let's say it doesn't, right? Because it's not certainty, right? And it's just a seasonal tendency, right? If it doesn't, I guess you're gonna know soon enough. If you get past the 20th of December and the stock market not only didn't start to run up, but actually it's starting to break some significant low, like last week low or something like that, then you might say, well, maybe I should reassess my expectations on the Santa rally. But up until the point that doesn't happen, I'm still of the opinion that we might see it. Um, just quickly, that that is basically the reason behind the potential uh, rebalancing dynamic, and therefore a little bit of weakness or stagnation or started stepping stocks. Because if you look at how the S&P and the bonds performed this year, you see that, for instance, in a 60/40 portfolio, given the performances of the two different asset classes, what you might get is now that allocation shifted to a 65/35. So in order to rebalance before getting to year end and being, let's say, so to speak, compliant, right, to annual reporting, where you need to reflect this type of allocation, you might see big money managers selling, decreasing 5% of their exposures into equities and increasing 5% of their exposures into the bonds. So just be aware. And it's just a consideration. At the end of it's not forecasting a huge drop, same as it's not as saying that we are due to a massive Santa rally, no matter what, because seasonal tendency, they don't always manifest themselves. This is another one about the different type, basically the divergences in the returns and the performance of, say, SPY and a TLT. So bonds versus stock in this scenario of a 60/40 portfolio. You got the two assets, and then you got, of course, the ratio in between them, right? So again, you see that when you got a little bit of divergence in between the two, they tend to get back in line in due time, of course. Again, it's not something which is going to be actionable tomorrow morning, right? But this was kind of cool, right? When you talk about the stock market, there was this kind of nice survey where it looks like everyone is expecting the stock market to skyrocket, but at the same time they're expecting their income to stay flat. So yeah, I'm gonna be miserable because my income is gonna suck, but hey, the stock market is gonna run high, right? I should buy into stock in order to benefit, to profit from a little bit of that. Um, I mean, we do know the risks associated with euphoria, right? So just be aware of that. And another funny thing. Now, If you check now on the left, this was the pandemic drop. It looks very meaningless now if you compare it with what we had for the following months and years, right? But it looks like we are now in a similar stage to what brought us into the choppy madness and drawback process of 2022, right? We got Bitcoin mania. Um, Back then, we got IPOs. There was a point where IPOs, the pace at which IPOs could be sold out wasn't enough for the amount of liquidity which was chasing assets that we needed. We needed to come up with sparks once again, right? And of course, the huge amount of options and all the meme stocks that, if you do remember the case of GameStop and whatnot. Now we got kind of the same, right? We got again Bitcoin, which is hitting the news. 0 day options, because if you don't think options are leveraged enough, why don't you add intraday options to it? And of course, we got leveraged ETFs, single stock ETFs, and the AI mania, which, yeah, contrary to what many people believe, it's not over yet. So we are reaching into level of exuberance that historically they tend to precede a little bit of a, again, not talking massive crashes, but just, if you look at 2022, a little bit of a choppiness, a little bit of a pullback, ordered pullback, if we gotta have one, right? So just, you know, expectations are a terrible thing to have, because at a point they're going to be unmet. So even if you check the earnings, the estimation for earnings, uh, they are forecasted particularly high for the next year, and the forecast is actually diverging a lot from what would be the linear type of trend they should have. So as you can see, every time they diverge a lot, what you got then or after it is a mean reversion. So I guess 22 was a good example. If you check the what was expected getting in 2022 was these, right? And then though, you know, 2022 looked a lot like uh, like a mess if you check it. So just bear in mind that expectations might be set up for a disappointment at a point down the road, right? Struggled a lot getting back to 2022, right? At the end of it, if you look at the change in earnings, that is a good indicator. I mean, for the medium term, of course, not for the short term, but still relatively good. Now, this one, okay, again, credit to Anthony for posting it. Beyond making me laugh a lot, because of course, if you just read, if you check the faces, it was just hilarious, right? But to finish up, there was a nice consideration I wanted to make about what a Trump presidency might be for the stock market. This is just a good starting point, because, of course, he said, "Don't want to get in that situation where everyone is buying, and then you got the market dipping, because that's something which can actually happen." Now, just briefly, Trump was particularly vocal throughout his campaign about making this economy the best economy ever. Um, and if you check back in his previous term, he was measuring his achievements and results using the S&P, or basically the market, as a benchmark or a reflection of his own results. Now, isn't it strange that recently he didn't talk about markets? Like, Not really, right? Um, and a lot of what he's proposing, assuming, big if, assuming it's gonna actually come to fruition, but a lot of what he's proposing could actually be not very good for markets in general, right? Like it could be very disruptive, so to speak. Could be it could bring in a lot of uncertainty, right? In markets, they don't like uncertainties. Now, he was also interviewed, I guess it was NBC if I remember correctly, and he was saying there was a specific question, right? Um, he was asked, do you think can you guarantee with all what you are proposing, like for instance tariffs is the big talk, can you guarantee we are not going to see a revamp in inflation? And it was very candid. He said, I can't guarantee shit, you know. Um, listen, we gotta do that for the sake of the country over the long run, and if that really means causing a little bit of a downturn in the S&P and market, I'm fine with it. I actually got a mandate from the American population. They are asking me to do that. Guess what? Because at the end of it, even if the stock market it's really running, 80% of the population it's not benefiting from it because they don't own stocks. All right. Plus, on top of it, if the market has a downturn, and especially if it has it throughout the first year of my term, I can very comfortably blaming it all on who was running the country ahead of me. So the Dems. Because at the end of it, that's the reason people were so vocal in electing me, and they elected me mainly on my economic type of a platform. They want a better economy. So if I got a downturn in the first year of my mandate term, sorry, it's all cool. I can very easily blaming it on the other side and say, well, at the end of it, we are just paying the consequences of the people which were running the country before, and this is really the reason why I'm here today. And you put me in this chair because you weren't in line anymore with that type of economy. So it was just curious, and it is curious overall to see how it completely switched from talking about a roaring economy and how it's gonna be fantastic from day one to keep on being, a bit more cautious, right? A bit less exuberant. So maybe at the end of it, I'm not saying him personally, but maybe someone in his staff actually warned him about, look, if you keep on going ahead and if you keep on going around talking about the wonderful economy you're going to build up, you risk to create high expectations in the public. And then when a downturn comes, if it comes, it's going to backfire politically a lot against you. So just, it was fine having all these claims where you needed to run and to be elected. But now that you're actually elected, try to, tune down the enthusiasm a little bit, because we know that after enthusiasm, what comes in, it's disappointment, right? So I guess, at the end of it, it's what every politician actually does. Uh, they're very on fire when they need to run, and then, from arsonists, they become the firefighters. So could be it, right? It's going to be particularly interesting to see what is going to happen with its policies and how the markets are going to respond. Um, I keep on thinking, right, to go full circle, that no matter all the stimulus and all the liquidity which was injected, uh, one of the main reason people are discussing for the stock market to plunge, it has to plunge, right? I don't know. Everyone is saying that sooner or later a 30-50% correction is going to come, right? Okay, but myself included, I think at a point the liquidity which was injected with the CHIPS Act, Inflation Reduction Act, it's going to be out of the system. The problem is, since we have not seen any other type of intervention from the government on that scale and in that direction, then why liquidity it's not slowed down or tapered down? Well, again, I think at the end of it, what you're looking at and why the stock market is particularly resilient and it keeps on grinding to the upside is because of capital flows. You might think there is no quote unquote new money printed by the US government. The problem is the rest of the world is looking around and everyone, like Germany, France, most of the Eurozone, China, Russia, they're all struggling. And it looks like the US, when it comes down to financial markets, it's the only game in town. So if I got capital to allocate, I need to be allocated there because it's the only market which is performing. And not only that, but the dollar is crashing our currencies. What what are we going to do? It's again, it's the milkshake theory. Strong gold, strong dollar, strong US equity markets. It's I know a lot of people don't really like that theory because they just look at one part of it, which is the dollar is going higher, and they think no, it's not going to happen. I've always lived in America, and the dollar sucks. It really, pardon my French, but it sucks dicks. It's losing purchasing power over time. Over the last century, it lost 90% of its purchasing power. Yeah. So if you don't like your dollar, think about the other currencies around the globe, right? That's it at the end of it. So just try to, again, to give it some thoughts, right? And with that, we officially broke the record for the video durations. So I'm gonna leave you off with that. Was a good one, I think, particularly long, but as you saw, the week was particularly intense, and it brought in a lot of different topics of our conversation. So after busting your balls for 1 hour and a half, I'm gonna wish you a good rest of your Sunday, a good start of your week, and yeah, I guess soon enough, I'm gonna need to say Merry Christmas, but not yet, not yet. All right. Anyway, folks, have a good one. Be nice and be cool, and hopefully, if I didn't bore you enough, I'm gonna find you back next week. Nils out.